Steve, well, we're letting people in here. I want to get started by introducing my SRM colleague, Steve Shaw. So Steve's obviously on this call, and Steve has 25 years in banking, payments, data services, and has led marketing strategy at top firms, including Fiserv and Euronet. He is a recognized thought leader, has been featured in American Banker, Credit Union Times, and major industry events. Steve is going to be taking the role on of SRM Perspectives brand, kind of managing that, which includes this webinar series. I'm going to be transitioning to a new role, leading our AI, stablecoins, and tokenized deposit strategic advisory offerings. I'm still going to participate in Perspectives, just not the lead. I also want to thank our long-term participants. We've been doing this kind of nearly for 3 years now. We started with Crypto University, then Tech Talks, and what's now Perspectives Live. So super excited. Steve, we'll give you a chance to say a few words, and then I'll share my screen and we'll get started on the presentation.
Yeah, thanks for the introduction, Larry. Happy to be here. Happy to kind of join in and see how these go, and I've been having various conversations with Larry and some of our clients and customers, and understanding where we can take this, and excited to move forward with it. So
thanks, Steve. Appreciate the support and looking forward to seeing you do great things with Perspective Live. So with that, Victoria, I also want to thank Victoria Franco. She's been on this series for a while now, helping me organize this stuff. She does a great job at it. Victoria, if you don't mind launching, so we've got 2 poll questions to kind of get kicked off, and I'm just curious kind of what people think about the first poll question, if you can launch it, Victoria, is going to be about whether or not you see stablecoins potentially disrupting or disintermediating traditional finance. So just simple yes, no questions. And I just see there that host and panelists can't vote. Man, I know what I would vote on this one. So Victoria, I should know how to view this. Oh, there we go. You took care of it for me. Yeah, so 79% thinks it could disintermediate traditional payments. I obviously agree pretty strongly with that. The 21% that said no, not totally surprised by that. Like I think for me, it's a question of when, not if. And, that when could be a long time from now. It could be 10 years from now. In the US, we were not very quick at adopting new payment methodologies, but we kind of eventually get there. And we'll talk about some of the stats as it relates to kind of international usage of stable coins. But with that, let's launch a second poll question. So if you're a financial institution, bank or credit union, are you, considering building a stablecoin strategy? So, are you doing that now, within the next 6 months, or no plans? And this one I'll be really interested in, because we have had a lot of folks who have approached us for doing board and executive level presentations. And I think I've done about 7 of those so far, maybe 8 of those since the Genius Act passed earlier this year. So it's a very popular topic with boards. In fact, we're doing a lot of AI presentations, and it has surpassed the number of AI requests pretty significantly. So this will be interesting to see from a percent standpoint what the listeners are doing. All right, so yeah, this is pretty interesting. So currently, about 17% are considering building a stablecoin strategy. My advice to everyone is going to be everyone needs a stablecoin strategy for sure. How quickly is going to be important. We'll talk about the timing of this and why it may be important, not necessarily be first, but you certainly don't want to be last. 33% of you said within the next 6 months, and then about 50%, half of you, no plans. And that's maybe what we're seeing in the market. The 17% or so, we're probably seeing about that, a little bit higher with our clients and potential clients in terms of reaching out to us to request education on this. So with that, we'll go ahead and let me share my screen. All right, there it is. Okay. Steve, I'm guessing you can see this. All right. So let's kick this off today. Obviously, we're going to be talking about stablecoins and tokenized deposits. Stablecoin is not surprising if you've been watching the news. It's certainly reshaping the payments landscape, prompting a lot of big players like Mastercard and Visa to adapt to a system where there's going to be fewer intermediaries needed at any transaction. Unlike traditional payments, which rely on multiple banks, credit unions, payment networks, stablecoins really streamline transactions by leveraging blockchain technology. Some of the issuers would be Circle. Circle's now a public company. They issue stablecoins that are backed by fiat reserves. For those of you who aren't familiar with fiat reserves, that's kind of traditional money. It's Latin for let it be done. But those fiat reserves are held in a custodial bank account. So issuers, again, the Circles of the world will have those one-for-one backing in a custodial bank account, meaning that only the stablecoins issuer's bank is typically required to facilitate transactions. So once you've got that one-for-one backing, you don't need any other intermediary. So significantly reduces the role that other banks and credit unions play in payment processing. In 2005, this year, developments like Fiserv's recent announcement to issue a stablecoin and pursue a merchant acquirer limited purchase bank, MALPB, charter from Georgia highlights the potential for non-bank entities to serve customers directly, bypassing traditional finance institutions. We've had tech giants like Apple and Meta and large merchants like Amazon that have announced that they could follow suit. And if any of these announcements really come to fruition, banks and credit unions might shift increasingly just serving as fiat on and off ramps, facilitating conversions between US dollars and stable coins and or acting as digital wallet providers. And I think that would be bad if that was the only thing that credit unions and banks could do. We may also see traditional finance issue their own stable coins. This could be a trend that could become certainly feasible as initiatives like the UBIC stablecoin clearinghouse starts to take shape. We'll talk about that later. Additionally, it's also been announced that a large bank consortium is working on a stablecoin and or tokenized deposit offering. If we do see widespread acceptance as a digital equivalent of dollar, so you think about stablecoins as a dollar derivative, users could, in theory, transact indefinitely without ever converting back out to fiat, further reducing reliance on traditional payment systems. I think it will be a long time before we get there, but that would be really disruptive for traditional finance. So this is an interesting stat. So if you think about internationally, and I've looked at this number a couple of times, I still don't believe it, but it's out there and it's a pretty significant number. It's based on a survey of about 300 international payment and banks across the world. And what they found was about half of them, 49%, are already using stablecoins. Now, a lot of those were in Latin America and Asia Pacific markets, but again, that's a big percent. So internationally, stablecoins are already a thing. Just in the US, not so much. And I think we've got a chat already, so I'll get to that here in a second. We've had also large cross-border companies like Stripe, Western Union, MoneyGram, Wise, PayPal, starting to integrate stablecoins in their offering. And then obviously we had the passing the Genius Act, which I think signals mainstream momentum here in the US. So we're going to explore these trends and what it means for future finance. But just let's take a quick look in the chat. Nope, you're right. Haven't been moving any of the slides yet. I've just been talking. So that's always the danger of this this first slide is I love to talk and just give a little background on it. So with that, let's get to the slides. Just quick disclaimer, we're not giving any financial advice here. This is not investing advice. This is considered educational and entertainment purposes only. So what is a stable coin? Well, they're essentially stable. They often act as a bridge between traditional money and digital currency. At least that's kind of where they got their start. They're fully redeemable on demand. They leverage blockchain and they allow for 24/7, 365 global secure settlement. Hence, they're very useful for P2P and B2B international payments. Now, again, doesn't mean that that's not useful for domestic transactions. So how big are stable coins? I guess the short answer is big. So if you think about volume versus market cap is how much stable coins are out there at any given point in time circulating. And then obviously they can be used for lots of transactions. If you look at the number of transactions that generate worldwide on a 12-month basis, it's $38 trillion of money movement. That's a lot. Most of that is trading activity. So most of that is kind of bot activity with crypto trading. However, about 20% of that, so $7 to $11 trillion, would be non-trading activity. And a good piece of that is B2B payments. So just by comparison, Visa's annual transaction volume is 16 trillion globally, and Mastercard's is 10 trillion globally. So, it's about as much as Mastercard is in terms of, again, most of that being B2B payments. Most industry experts in the space, and basing on kind of existing adoption curves, we expect the market cap to increase from 260 billion or 271 billion to about 3 trillion by 2030. That's a 10x increase. Whether or not that increases 10x of worldwide stablecoin volume, if it did, that pretty much eats all up every payment mechanism that's out there today. I don't think that's going to happen, but the number is probably going to be pretty large. And U.S. Treasury is based on a report from, I think, April, expects that about $6 trillion of existing U.S. checking and DDA balances are at risk of moving to stablecoins. And we'll probably talk as we get a little further in there about why that is. $6 trillion is a lot. Some of you may have seen a recent post of mine on LinkedIn. If you haven't, go check it out. But there was an article in Payments, I think it came out today, maybe yesterday, about the banking lobby pushing Congress to rewrite the Genius Act and close some of the loopholes. Primarily, what they're worried about is that $6 trillion of deposits moving out to stablecoins. And the reason why is that stablecoin issuers, at least by Genius, the Genius Act is not allowed to provide interest on those stablecoins that a user would be holding. However, they didn't stipulate that you couldn't pay rewards. So the fintech companies that are out there that are already leveraging stablecoin are looking at, well, hey, we can just call it something else and we'll give you rewards in the form of like, Bitcoin or Toaster or something along those lines to get around the idea of just paying interest. So, I can certainly understand that's a concern from traditional finances, that you don't want to be competing with existing deposits. I don't suspect that they're going to have a lot of luck making that argument to further limiting stablecoins. One, because the existing administration is very stablecoin friendly, but also stablecoins represent combined about the fourth larger of U.S. purchaser of U.S. treasuries. So we kind of need that to fund the government. That's kind of a weird kind of game theory aspect of stable coins, but that it's something that is required right now to find purchasers of treasuries, stable coins, because they have to be backed by treasuries or short-term cash instruments, or happen to be the largest holder or one of the largest holders of treasuries. So with that, I'll pause. Steve, is there anything in the chat? I've got my slides up, so I can't quite see the chat questions, but I'll pause here to see if there are any questions. And we can certainly take questions at the end too, but.
You may have answered it already, but there was one in here of like, what percentage is the norm of stablecoin reserves are treasuries versus cash?
Great question. And I'm not 100% sure. I should know this. I haven't looked at it for a while. I'm willing to speculate probably 70% of it would be treasuries. The cash is held only so like you need to expect a certain number of days of redemption on stable coins. And because these things have to be fully redeemable on demand, you have to hold some cash on hand to make that instant, right? So instead, you don't want to have to be trying to figure out how do you sell your short-term treasuries. Those short-term treasuries, I think, have to be 93 days or something. Like they're fairly short-term. But the only other thing that you can hold is a cash-like instrument, and this is for the treasurers in the group, would be repo and reverse repo purchase agreements. So. Why all the hype? Well, if you haven't been watching the news, a lot of big articles about stable coins and very, very big institutions looking to get into that. There's also been some less significant headline grabbing developments in stable coins. So because stable coins offer the benefits of low cost, instant and international transactions with little to no intermediaries, the fintechs, merchants, payment processors, and traditional finance are all rushing in to insert themselves in the process, because it's clear to many of today's participants won't be required. And we'll talk about why that is here in a bit. A couple more recent accelerators would include, and I didn't put them on this slide, but a successful test of FedNow transaction. You're saying, well, why FedNow? We're talking about stablecoins. Well, you can also use it with stablecoins, but they tested a transaction using QR codes and the new X9 protocol. So you could do that with stablecoins or any payment instrument. So it just makes that kind of payment, which a lot of people aren't used to, FedNow, RTP, stablecoins, account to account, whatever it may be, very easy to transact, say at point of sale or, as a P2P type transaction using your phone and a QR code that is secure. There's a whole nother conversation we could have around X9 protocol, but suffice to say, it eliminates some of the friction of doing a transaction. Similarly, a company called Xeno, Xeno, has launched a solution that allows your phone to become a tap-to-pay wallet, just like Apple Pay, but fully decentralized and powered by stable coins, in this case USDC, on the base blockchain, which is Circle's blockchain. Again, could make it very easy to facilitate a payment at point of sale. So both QR and Tap innovations have a pretty easy UI, UE, and again, could facilitate mass adoption. I'm not saying mass adoption would happen, but I think we are going to see adoption at some level. So Stablecoin Genius Act, this is kind of what really drove a lot of interest in the US around this. Genius Act stands for Guiding and Establishing National Innovation for the US. There's another whole story about why this thing was named Genius and then the other act named Stable. I won't get into that, it's pretty political, but it's very funny. But at any rate, the act classifies payment stable coins, so the USDC and the PYUSD, as being distinct from securities or interest-bearing assets, but does not yet treat them as legal tender or cash equivalents. So today they're currently treated as property. I do expect, given the current administration, that the accounting bodies will probably look at treating this stuff differently in the future. Probably more like legal tender or cash equivalents. They're pretty close to cash equivalent, but I'm not an accountant, so don't quote me on that. Some key provisions of the act are that only permitted stablecoin issuers are subsidiaries of insured depository institutions, so banks and credit unions, and those subsidiaries would have to be like a CUSO or something similar on the bank side. You couldn't directly be a bank or credit union issue a stablecoin, is my reading of it. Federally qualified non-bank issuers, so these would be the Ripples of the world, the Circles of the world, the Wises of the world, and they have to get licensed by the OCC, or state qualified issuers. So depending on how large you are as a stablecoin issuer, I think if you're over 10 billion in market cap, you have to be regulated at the federal level. Less than 10 billion, it can be state regulated. Issuers must maintain reserves on at least a one-for-one basis, so you could over-reserve, but you can't under-reserve, using low-risk assets like U.S. currency, demand deposits, treasury bills, maturity less than 93 days. I said that before. Certain repurchase agreements, repos, reverse repos, and stablecoin reserves cannot be rehypothecated except for liquidity purchases. So whoever is holding those reserves, typically today they're held by, like the treasuries are held by BlackRock for like at least Circle, and then the cash is held by U.S. Bank. There are a couple of big banks that are acting as custodial agents. They got the appropriate license to do that, but those can't be rehypothecated back out. So this is not fractional reserve banking. This is full reserve banking or flat banking for those of you who know what that is, which is weird because Federal Reserve has not allowed that for a long time in this kind of a roundabout way of getting to flat banking. Regulatory oversight outlines that the federal regulators, so Comptroller of the Currency, OCC, Federal Reserve, FDIC, and NCUA will oversee the federal issuers, while state regulators will supervise state qualified issuers. Issuers will face strict oversight, including regular examinations, capital liquidity requirements, and consumer protections. Issuers must publicly disclose redemption policies and monthly reserve compositions, so they have to be audited on a regular basis, I think daily, maybe weekly. Payment stablecoins are not explicitly classified as securities. Stablecoin holders receive special priority in case of issuer insolvency. This is an interesting one because they literally changed the bankruptcy law in the US for like the first time ever, which is it puts the holders of those stablecoins above every other creditor in the case of a bankruptcy, including the attorneys that would work on that bankruptcy case. So stablecoin issuers get paid first. If you're a bank, a custodial agent, you fail, You go bankrupt, they're the first ones in lines before any other creditors. So very strong protection if you are a holder of stable coins, because those are backed by things held by a custody. Those custodies are, basically bankruptcy remote. Steve, any questions so far? Cool. That means I'm being fairly thorough, hopefully.
Yep.
All right. So stable coins are interesting. Stable coins are privately issued, typically on public permissionless blockchains and outside of existing payment rails. They're fully collateralized, so full reserve banking. At least by law today, per Genius Act, you can't pay the holders interest. That doesn't mean that the holders of the underlying assets that you're custodying those assets can get paid. They get paid a lot. They basically holding U.S. Treasuries. If you're a custodial agent, like you're a Circle or a Tether, that's kind of an international stable coin, USDC, they make a ton of money because essentially people are giving them cash or deposits for them to hold and turn them into stable coins, that the stable coins are then being used for national transfers or in crypto or whatever. And they're getting basically cash for free and earning treasury yield. So it's a great business model if you can get into it. Tokenized deposits, on the other hand, act very similarly to stable coins, but they tend to be on private permission blockchains. There's really only one out there that I'm aware of that outside of kind of trial mode, and that's JPM Coin. They, however, are backed by they're kind of fractional reserve banking. So it's a deposit of a token of an existing deposit, meaning that they, as you would expect, would be FDIC insured. And some examples, again, would be JPM Coin. Citi has a service called Tokenized Services, so they can provide that to other financial institutions as a service. And then, some regulators aren't differentiating between the two. That's kind of changed with the Genius Act. So they kind of carved out the tokenized deposits. I think I saw a question. Maybe someone put something in the chat. Steven, is there anything up there? I could be wrong.
We were just putting out another feeder for questions if anybody had any.
Cool. Appreciate that.
One just came in, Larry. So are there examples of banks or credit unions successfully integrating stablecoins into their operations or customer/member offerings? Or are we too early?
So domestically, man, I don't know. Actually, that's not entirely true, because there's a company called Bank Social that's worked with some credit unions. They've got a Bank Circle token. I think they've put out there kind of as on a trial basis. They've made some actual transactions using stablecoin. So I think the answer would be yes. That's fairly early. Internationally, quite a few large banks use stable coins today. Santander, one of them, that can't think of a bunch of them come to my mind, but approximately half of international payment providers are using stable coins today. It's just in the US, we haven't had that regulatory clarity. So, traditional finance players are very conservative, as we all should be. We're highly regulated. And so no one's been really willing to try this stuff, other than, there's been some trials with the Regulated Liability Network and Regulated Settlement Network and things like that. And those have been big banks that participated in that, but no real implementations of stable coins, tokenized deposits against JPM Coin. But outside of that, and maybe the small trials by Bank Social. But that said, I would expect this to start happening fairly soon. And we'll talk about use cases, but one of the great use cases is receiving stable coins. And then, there's a lot of credit union, community banks, large banks too, that have international customers. I talked to a credit union the other day that had a lot of workers that, tech workers, and they moved to US have family in India, and they wanted ways to send money back to India and make purchases and stuff like that without having to go through correspondent banking, or using like a MoneyGram, which, the cost of traditional international money transfer is about 6 to 7%. Well, the cost when you do it with stable coins is usually 1 to 2%. So significant advantage to use stable coins. So this particular credit union was interested in maybe using that for their particular member base. I know that was a long answer. Sorry about that.
So that kind of begs a question for me, I guess, Larry. So if you look at comparing this to maybe like, the influx of real-time payments and instant payments, and a lot of financial institutions are receiving instant payments, but the idea of actually sending, do you see that being the way that, financial institutions dip their toe into this of, yeah, we'll be able to receive stablecoins or tokenized deposits, but the ability of them, going out is a little bit more of a risky endeavor?
Risky, maybe. We can talk about risk here in a bit, but from just a natural, like everyone wants to receive deposits, no one wants to lose deposits. So it's a natural, yeah, let's
Of course. Yeah,
send, receive. That makes a lot of sense. Now, while I said banks and credit unions aren't using stable coins today, and again, that's largely because we just got regulations around this. The fintechs have been using it a lot. And so, a lot of use of stable coins with the gig economy and payouts, just like we see with FedNow and RTP, where that is very popular. And so, financial institutions that are getting into FedNow and RTP, gig economy, payouts, cash outs from online gambling, there's a whole bunch of things where this makes a lot of sense. And while it's still small as a percent of overall payments, it's increasing very, very quickly. I would think stablecoins would kind of fall in that. Like stablecoins almost compete with FedNow and RTP. FedNow and RTP are great solutions, but they're domestic, right? They were built for the domestic, not international. Where stablecoins have already been used for many, many years, probably 14, 13 years on an international basis. So they really have some advantages over FedNow and RTP. Also, they could be considerably cheaper, but again, could be a little bit more complex. So there's probably a proper place for every type of payment transaction, not necessarily that stable coins will take over all of them. Like, we've built some really great payment solutions, credit cards included in there over the years. I don't see any of them disappearing real quick. We still use checks today. But I do see this finding another place and, eventually just seeing a shift in where the volume goes for different payments. But great question, Steve. All right. So, well, there have been some tokenized deposit trials. I mentioned that. There's no real active deposit solution implements in the world outside of JP Morgan being the exception. However, stablecoins are being actively used for cross-border settlement, everyday transactions, store of value in terms of holding a USD derivative. Very popular in a lot of other countries where you can't traditionally hold US dollars, or it's very difficult to do that. People holding stablecoins because all you need is access to online. And, they're not even converting into local currency and using for transacting, just using as a way to store value because the US dollar is depreciating in value at a fast or at a slower rate than their local currencies. But, difference between stablecoins and tokenized deposits, you can see some of there on that slide. I've already covered those, so I'm not going to cover I'm not going to go into a lot of detail on this one. It is interesting to kind of consider, well, and I get this question a lot, what's the use case for stable coins? And actually my answer now, it used to be that it was difficult to answer that. Now I say it's a use case for everything you use cash for today, or even checks today. And tokenized deposits, if we saw a proliferation of those, would also have similar benefits. So, from an issuance standpoint, stablecoins are issued by private entities, where cash is issued by central banks. Depending on how you look at it, can be advantage, disadvantage. In terms of backing, backed by various assets, considered legal tender by most countries is cash. Regulation, highly regulated. The cash is regulation. I'd say, the regulatory framework is developing on an international basis. At least we've got some here in the U.S. That's largely being sorted out. Transparency, one thing that, and again, this depends on how you look at it. If you're looking at it as a private citizen, it's nice to have an anonymous. Being anonymous, autonomy. Being anonymous, it's nice to be able to be anonymous in terms of cash transactions. Stablecoins are pseudo-anonymous. So, people used to think they were very anonymous. Actually, turns out they're very good for tracking. So criminals don't use stablecoins a whole lot, or cryptocurrency. That's kind of a meme from a few years ago. But the reality is, and I'll throw this in with the broader digital assets. Digital assets are used about 0.25% for illicit type transactions, 0.25% of volume, whereas cash is about 7 to 8%. So 7 to 8%. So, stable coins and digital assets actually have an advantage there. Transaction speeds, can be very quick, obviously very difficult to send physical cash places. Financial inclusion, stablecoin can provide banking access for people that have been traditionally excluded. So from a financial inclusion standpoint, it's got an advantage. Big advantage of stablecoins is this programmable. So it uses something called smart contracts. I can't remember if I have a slide in here on smart contracts, but essentially it's kind of making automated financial transactions where you can't make that automated today. Think about like if you combine stablecoins with agentic commerce or AI, and you get that agentic commerce where you can have AIs make transactions, particularly low volume or small transactions on our behalf. And then use cases, lots of use cases for stablecoins. So what are the implications? So this is one we're spending a little time on. So obviously we've got new rails here that are lower cost, faster settlement. That doesn't mean that they've got uses for everything, but tokenized money enables 24/7, 365 real-time settlement anywhere in the world, reduces reliance on ACH, SWIFT, and card networks. Again, this will not change overnight, so we don't need to panic, but we do need to have our eyes on this. Processing fees would stablecoins drop to basis points instead of 1 to 3% on cards. And obviously it depends on the size of the retailer, but you can see where there's obvious implications here where merchants might like this stuff. And financial institutions might not because you get less interchange. There is a big disintermediation risk. So if we were to ignore this and just let stablecoins exist in a vacuum and eventually gain some traction, and people start to like the idea like, oh, I can do P2P type transactions. I don't need to involve my bank or credit union, and it costs me next to nothing to do that. I wouldn't underestimate the general populace for figuring that out, especially as we eliminate a lot of the friction involved in the stablecoin transaction today. So that just if you haven't ever made a stablecoin transaction, open a MetaMask wallet, or even go to like your PayPal account. You can do stablecoin transactions with that now. Try it. Some use cases remarkably easy, and you'll go, oh my God, I can do this. I can send money anywhere in the world, and I don't have to use my bank, and it happens instantaneously. Others, you'll go, how in the world do I ever use it for a transaction of point of sale? Like you are going to find benefits and you're going to find drawbacks. And within that, there are things that traditional finance can solve if using this technology. And that's where I think there's some opportunities. But again, disintermediation risk, I mentioned earlier and hinted at, stable coins have a potential of eliminating or reducing significantly the number of intermediaries in any financial transaction. And if you happen to be one of those intermediaries that get left out, your business model has disappeared overnight. Because there are fewer trusted third parties that are going to be required for those transactions, there's less economic rent to capture, which means less money to go around, which means if you think about interchange, less interchange than a card transaction, potentially. I just said threat to interchange, especially for smaller institutions, infrastructure evolution, movement towards a shared unified ledger. So these things operate on a blockchain. If you're not familiar with blockchain, that's another conversation. But as you get more familiar with blockchain, there are some real benefits to, like if you think about cores, which cores are just financial institutions, individual ledgers. Those things are unique to every financial institution. When you move money or move value, there is a kind of a swift messaging system where there's a message that gets sent first. It happens at the speed of light, but then the actual, and that's to kind of do the transfer liabilities. There's an back-end asset transfer that happens usually by a Fed wire. And that takes some time, and there's a reconciliation process. So like that's why we have T+1, T+2, T+3 settlement delays, and that's why they're, at least on an international basis, if you're a bank, there's settlement risks, not so much domestically, but that's why like these transactions are slower and cost money. As we start to, and this is not something that will happen today or instantly or next maybe even a year or two, but as people start to get more familiar with the idea of blockchain, which is a shared public ledger, you could even imagine a private public ledger where these things are shared. If you're on the same ledger system, a good example of this would be regulated liability network or some of the trials that BIS, the Bank for International Settlements, has been doing, like Project Agara. They're looking at doing transactions and having banks on the same shared ledger. That's basically moving cores from like traditional mainframe to cloud to blockchain. not going to happen tomorrow, but getting familiar with stablecoins and blockchain gives you an advantage when that time comes when you have to move to unified ledger. Someone just popped something in the chat. See what's a question there, or is there a question?
What about features and benefits that blockchain introduces and enables the transformation of current legacy platforms?
Yeah. So the difficulty in that is it's like anyone who's gone through a core conversion, it's a nightmare, right? It's not something you want to do. Imagine going off of the core to a shared unified ledger system. It would be a nightmare. There are a lot of advantages to blockchain in terms of settlement speeds, in terms of reduction in mistakes, inaccuracy. They are unbelievably secure. They are a lot more auditable. There's all sorts of advantages of blockchain, but that doesn't mean that it's easy to move off traditional systems. I mean, it's already difficult to move our traditional systems or change our traditional systems. Moving to a blockchain is very, very difficult. Not to say it won't be happen, not to say a consortium of banks are going to figure this out and offer a solution that they sell to everyone else at an elevated cost, but it's going to take a while. Good question. Were there any other questions there, Steve?
Not from here, but I have another one for you. So in thinking about how stable coins are issued, right? Non-FI entities and the likes, is this another scenario where we have, say, an Amazon stablecoin and then a Walmart stablecoin, and you go into Walmart and you don't have your Walmart stablecoin and you get it, or is there going to be a infrastructure or a standardization, if you will, that will enable that to be more ubiquitous for consumers?
So there is, and I'm going to talk about that. I have a slide for that. There's a concept of a stablecoin clearinghouse. So if you think about you're a financial institution, you accept other financial institutions' checks, even though it's not your check. That's allowed, and we do that because there's a clearinghouse and a settlement function that clearinghouse provides. So if you're part of the clearinghouse, everyone's checks are essentially, equal to $1 kind of deal. Same could go for stablecoin. So that could happen. In terms of the big retailers, like there's a major advantage for retailers to accept stable coins, also to issue stable coins. Are they looking at that? For sure, some of them are, some of them might not be. It's still fairly complex. You have to have adoption, you have to have distribution. But there's a big advantage for the Walmarts of the world to do this. But again, it's not simple. So yeah, for sure they're looking at it. The problem is that if someone figures it out, whether it's enough Fiserv literally, if they did this right, wouldn't need the banks. They could do all these transactions without having to have any participation from the banks, because again, you're using a stable coin is essentially pre-funded with money sitting in a custodial account. One bank's required. If you're a Visa and Mastercard, you could literally run Visa and Mastercard transactions without having an issuer. You do it all through a digital wallet. You use stablecoins to transact. I'm not at all suggesting any of that is ever going to occur. But my point with that is a lot of the parties are realizing you don't need as many intermediaries now to conduct a transaction. So what does this new world look like with fewer intermediaries? I want to make sure that I'm part of that trusted intermediary network, and I'm not the one that's left last in the game of musical chairs. A new business model. So we'll talk about some of these: wallet custody, on and off ramps. Steve, you kind of mentioned that with would you want to receive stable coins? Like, absolutely. On and off ramps today, if you have a stable coin, you want to turn it into cash or fiat, you have to sell that stable coin to an exchange, and the exchange will cash out for you. If you're a big enough holder, like a really big holder, you could get the issuing institutions, so say like a Circle, to cash out for that. That requires burning a token, then giving back the cash that you've put into it. But it's a fairly convoluted process to do that. If you're a traditional finance, you say, hey, I'll accept those stable coins, and we've got now a clearinghouse where we can clear it through a clearinghouse instead of me having to clear it with all these individual stablecoin issuers. Yeah, that makes a lot of sense, and we can do that all day long. Payment APIs, treasury liquidity solutions. Like I'm not a treasury person, but there are ways, because this is a quick, easy, cheap way of moving money, and it has to do with treasuries and instant and eliminate settlement risk and things like that. There's a place for treasury solutions in here. And then we are seeing a regulatory shift. So what are the benefits? The benefits for all the different players, there could be different benefits, right? So for merchants, the obvious one is lower transaction fees compared to, say, credit cards. Instant near settlement, so it reduces things that they have to worry about settlement risk and getting paid on time, because it does take a while to get paid from a credit card. Reduce chargeback risk, dispute, although that said, there are some dispute solutions for stablecoins coming to the market, and then access to a global consumer base without currency conversion. So that's the benefit from a merchant standpoint. Looks like someone just popped something in the chat, so I'll pause to see if there's a question I can answer related to that.
Question is, what about an opportunity for a stablecoin revolving line of credit to transform credit cards?
I almost know who asked that question without looking at the chat. Yeah, there is an opportunity for that. It provides a really interesting opportunity. And that's where stablecoins could compete directly with credit cards, because credit cards, it's easy to compare a stablecoin transaction to a debit card transaction, right? It's kind of, it's against your deposits. It's kind of instant. It happens, fairly quick, and it's relatively less expensive for the merchant. A credit card transaction, though, obviously there's a credit function to that, and it's a very different type of transaction. If you had a stable coin that you provided, say, a line of credit against those underlying assets that were held, which you certainly could do, I would think, you could basically provide the same benefits. You do this through a digital wallet. You'd provide the same benefits of a credit card, but without the cost of a credit card, and cut Visa and Mastercard and other credit card issuers or providers out of the circle. Again, not saying that that's something will happen today, but that certainly is a risk. Great question. From a member customer standpoint, what would be the benefit? And this is hard, right, to consider, because like we all use credit cards today. I use my credit cards all the time. But one thing is I've moved from cash to credit card. Another thing is I've moved from using my plastic to using tap and go on my phone. It wouldn't take too much to think that in my Apple Wallet, stablecoins could start popping up as a payment option. So what would be the benefit for me as a consumer? Well, because this costs a lot less for the merchants, you can bet merchants are going to provide pretty significant rewards or incentives to use your stablecoin at point of sale. Great. The other interesting one comes back to something around the Genius Act, which Genius Act says stablecoin holders can't be provided interest from the stablecoin issuers. That doesn't mean they can't get rewards for holding those stable coins. So now imagine I've got a mobile wallet, like my Apple wallet, and I've got a stable coin in there from a particular credit union institution or Walmart. It doesn't really matter who the issuer is. But an issue would be the one that would probably drive these sorts of reward. That issuer couldn't pay me directly interest, but that issuer could give me something called reward. So you remember back in maybe the 80s, where there's some prohibitions against paying like maybe a certain amount of interest or interest on certain types of accounts, and banks and credit unions went to like, giving out free toasters and stuff like that. Well, you can imagine an issuer getting around the interest prohibition by paying rewards. That rewards could be in Bitcoin. Man, if I could receive Bitcoin as a reward, and it's not really called interest, there's not direct interest payment, that's a huge opportunity. The other opportunity, for those of you who are familiar with stablecoins and use in decentralized finance, I can put my stablecoins to use by putting them essentially into a DeFi contract and lending it to a liquidity pool for other sorts of purposes. And I'm not going to get into the depth of that, but there are different types of liquidity pools. Some of those unbelievably low risk to pay 2 to 5% in terms of annual yield. So imagine I'm a holder of stable coins, and I can hold it in a digital wallet, and it's paying me the equivalent of 2 to 5% yield on my stable coins because it's locked up in a DeFi contract, and there's little to no risk in that. Again, this isn't legal advice, but I would do that all day long. Why would I need a deposit account? Why would I need a checking account? You're not going to pay me 2 to 5%. Now I could go up a little bit in the risk profile of a liquidity pool, and now I'm talking 10% annual returns. How's a traditional finance going to compete with that? And that's why there's a big scare right now, where the traditional finance and the banking lobby said, oops, we made a mistake with the Genius Act. Yeah, we said you can't do direct interest payments, but what about kind of indirect benefits such as rewards? And that's, they're literally going to go back to Congress, ask them to rewrite Genius. And if you want any indication of whether or not that's going to likely work, consider the existing administration, how friendly they are to crypto and stable coins, and what the administration has done since Chase came out and said with open banking that, hey, okay, we're going to charge for access to consumer data. And, they kind of ejected the whole CFPB open banking rule. But what did they do after hearing about Chase's move? Well, the administration got pretty ticked off and went back and said, okay, we're going to rewrite the rule and we're opening back up open banking. So don't be surprised if you're a bank or credit union, you push for this from a lobbying standpoint, and the administration comes back and says, no bueno. Could be really bad. Someone in the chat?
Can you imagine Apple Cash as a stable coin and how it immediately reaches millions to billions of consumers?
Yeah, that's more of a comment than a question. And absolutely, that's a good example. Yes. That's exactly how this could work. Or you think about like Starbucks, right? Starbucks got a closed loop system. Well, that closed loop system would be more efficient for them if they moved to a stable coin. Now, what if you open that up to other merchants or other providers, or, there's all sorts of opportunities for merchants to do creative things. Now, if you're a bank or credit union, what are the benefits? Well, okay, the big one is like just not being disintermediated from the payment process. Increased competitiveness, not being disintermediated. There are new fee-based revenue opportunities. So if you are receiving stable coins, then essentially you could charge a redemption fee. If you are issuing those, and again, that gets a little bit more complex why a credit union or bank might want to issue stable coins. But let's say you are, there could be an issuing fee. Because these things are international, there's a lot of FX components to it. So you could have an FX fee as well, or spread. So there are some benefits to traditional finance. And then from a processing company standpoint, there's benefits in terms of new product services, revenue opportunities, simplifying cross-border processing, reduce the need for traditional payment intermediaries. So there's a little something for everyone. And that's when you've got a solution like that, there's a pretty high probability that we'll start to see it in the marketplace. So again, wouldn't suggest that, hey, this is something new, but it's probably not going to happen. I think it's probably going to happen. It's just a question of when. So couldn't get benefits without additional risk, right? Risk reward. There's lots of concerns about stablecoin facilitating interchange compression, certainly from a bank and credit union standpoint. I think there's some truth to that, but it's likely going to take a while before we see enough merchant adoption. The Visa, Mastercard are going to feel threatened to lower it. So like good example, I think there's been a news article that Walmart is looking at stablecoins. I'm pretty sure that Walmart actually isn't looking at stable coins, but Walmart saying they're looking at stable coins puts a little pressure on the next time they're negotiating their deal with Visa and Mastercard, right? So like some people are going to come out and say they're doing this even though they might not, because it gives them some leverage. Eventually, it's going to put some pressure on interchange compression. However, what we're likely to see savings is some of the high fees that some merchants pay for merchant cash advances. So if you're not familiar with what that is, if you're a merchant, it sometimes takes you a few days before the user who swipes their card before the merchant gets paid. So a lot of merchants, some merchants will pay essentially a cash advance on those funds, which is a loan at the cost of effective APRs of they're pretty high, like 20 to 30%. So stablecoins could be used to improve that settlement speeds on the acquiring side and allow for the merchant to get settled much faster than it's getting settled today with fiat. In fact, Visa is starting to do this, is leverage stable coins for payments, merchant payments, their transactions back and forth between some merchants. So merchants, limited adoption may hinder immediate benefits. Sorry about the dogs barking. From a customer standpoint, limited recourse in the case of transaction errors, refunds, or fraud. So we talked about chargebacks and disputes. There are some solutions coming to the market that would basically kind of like an escrow account where a certain percent of that could be, pulled back or clawed back from a merchant if they didn't make good on a particular product or service. Credit union banks, there's a cannibalization risk of traditional payment and deposit products. That's a big risk. And then payment processing companies, interchangeability challenges across different blockchains and different stablecoin protocols. So something we didn't really talk about is you could have the Circle stablecoin that actually operates on multiple blockchains. So imagine those kind of like, you think about how the rail system works. You got different owners of the rails, different owners of the trains. You kind of mix and match. You have the same going on in blockchain world. Like some of that will, I think over time will consolidate, but there is some complexity of using these rails. All right, so this is an important slide from the stablecoin flow of funds. So if you're familiar with an ACH transaction or a cross-border transaction where you've got the custodial or the cross-border banks, drawing a blank on what they're called. If you're doing a credit card transaction, even FedNow RTP, you're talking about 4 to 5 to 6 intermediaries. Correspondent banking was the word I was looking for before. My point with any of those existing payment rails require a lot of intermediaries. The number of intermediaries required for a stablecoin transaction is essentially 0. Now, you've got to have someone that's got a receiving wallet and a sending wallet. As long as they've got wallets, you can do that transaction. Not to say it's easy, but it could happen. So the obvious risk is that these transactions pose the risk of traditional payment methods and their economic models. There could be an opportunity to introduce few more intermediaries in this type of transaction, like a clearinghouse or perhaps fiat on and off ramps. And again, I think those are opportunities for traditional finance. So some of you have heard me say this before. The analogy I draw, and it's a pretty good one, is the game of musical chairs. If you're old enough to have ever played musical chairs, which I am, typically in like grade school, you get every bunch of chairs, you all kind of go around in a circle and they play a little music. Teacher is usually the one that does that. And then when they stop the music, you grab a chair. And as long as you grab a chair, you're cool. They remove one chair. And if you didn't have a chair when the music stops, you're out of the game. And the last person holding the chair wins. So it's not super important that you're the first one to the party, but it's real important that you're not the last one to the party. So right now we're seeing merchants, large banks, so the BMOs of the world, the Chases, the Cities, Wells Fargo's, a few others in there, the networks, including Visa and Mastercard, they're looking doing investments in stable coins. They're all rushing to understand the technology and how it could transform finance. We already talked about why the average person might adopt stable coins. They're starting to gain traction for practical purposes, like online purchases, especially international, remittances, peer-to-peer payments. You've got companies like Stripe integrating stable coins. They did a $1 billion acquisition of a company called Bridge. So if you don't think they're taking it seriously, $1 billion acquisition is a pretty big acquisition. You've got major retailers exploring their use. They are starting to become as easy as using PayPal and Venmo. Not quite yet, but they're getting there. Their low cost and instant payment programmability capabilities are very attractive to merchants. Hence, we do expect merchants to adopt this, providing significant benefits, i.e. rewards to incent customers to use this payment method. Additionally, the current drawbacks of stablecoins like lack of chargeback or dispute function are being solved for, and then some very creative stablecoin tokenized deposit solutions where rather than using US dollars to back the digital transaction, this is to the question that was asked earlier, sure that was Steve, it can be backed by a credit line, introducing a credit function like a very efficient credit card. So don't underestimate how close these solutions are to market. I know we've got 5 minutes left. I'm going to try to bring it home here. Mentioned earlier that stablecoins only require 2 participants, sender and a receiver. However, that model is limited to P2P and not bank to bank or even depositing in a bank. So that's what doesn't happen today. However, for the clearinghouse, just like checks, stablecoins could operate like a check, although a bit more like a traveler check. They're essentially a bearer instrument, redeemable at par. This would increase the participants in the flow of funds to about 5, much like the processing of checks today, but it would be a lot more efficient and a lot less expensive and a lot more useful than a check because it's essentially an electronic check that clears instantly that you could use domestic or internationally. Unfortunately for today, stablecoins remain trapped in a limited ecosystem. Because unlike traditional payment methods, there's no universal way to convert them back to regular money at full value or par. They usually have to be cashed out at an exchange. If you receive a check, a credit card, or a bank transfer, you can deposit it at your bank for 100% of their stated value, irrespective of the issuer. Universal redemption does not yet exist for stablecoins, but it is required for any system made up of many issuers and many acceptance points. So there's at least one organization working on a stablecoin clearinghouse. If you're a participant, all the stablecoin issues in a clearinghouse would be interchangeable and easily deposited at any participating FI. That clearinghouse is a company called Ubix, founded by a guy named Tony McLaughlin, the former Citibank executive, also chief architect of the Regulated Liability Network. Great white paper. If you haven't read that, would encourage you to. The white paper for Ubix is also really incredible to understand. If you're really into payments, read it. You'll go, oh my God, this could actually work. And stablecoins could become a thing. So it's not all downside for traditional finance. There is opportunity for credit unions and banks, but only if they act reasonably fast. If they don't, someone else, the merchants, the processors, the networks, or a consortium or clearinghouse are going to likely get to participate in traditional finance players like credit unions and banks could be relegated to simply just becoming a funding source, and that would be bad. Some opportunities for FIs include on-ramping and off-ramping. So partnership could enable efficient on and off-ramping of funds, allowing customers and businesses to transit smoothly between fiat and, say, stable coins. You could be a custody or wallet provider. There's benefits and drawbacks of both of those. You could enable clients cross-border, P2P, B2B, and various combinations of those. Obviously, you would want to charge a fee for those sorts of things. You could enable your clients and merchants to settle with stable coins. You can enable programming on-chain commerce, automating money movement because of the programmability and smart contracts of these things. You've already got some of the major networks, so Visa and Mastercard, they both offer stablecoin services today. So Visa has VTAP, which is Visa Tokenized Asset Platform. Another is Mastercard's, which is called MTN, Multi-Token Network. There's also the benefit of agentic payments, but a lot of use cases still be developed. 2 minutes left, parting thoughts, and then we'll go to questions. Banking is going to move to stable coins and tokenized deposits. How much and how fast is the question, not a question of if. Largest banks in the world are already involved in developing shared unified ledger platforms and utilizing stable coins. Stable coins facilitate full reserve banking, useful for P2P, retail, payroll, and cross-border. Tokenized deposits facilitate fractional reserve banking and useful for interbank transfers, treasury operations, large corporates. This is where Larry thinks those two are going to be differentiated. I think they're both going to exist in the future, but I think stablecoins have a real advantage. If for no other, they are about 10 years ahead of tokenized deposits. They both work with the existing legal and two-tiered banking system. You couldn't say that 6 months ago, but since Genius Act, they do. Moving to unified ledgers or shared ledger system could have significant impact on the number of banks and credit unions continue to exist in the US, because I'm willing to bet you that big banks would be the ones who would provide that solution, and it would be kind of like buying Zelle from those providers. You're always going to be at a disadvantage, and they just facilitate the consolidation of credit unions and community banks. Many of the existing platforms, i.e. disparate ledgers or cores, might no longer be needed. That's what I was alluding to with the previous comment. And finally, this could all be years away or come faster than anyone expects. Everyone is going to need a stablecoin or tokenized deposit strategy, else risk being excluded from the payment network. This is where I do my sales pitch. Obviously, my role is going to be to kind of provide the services for SRM to our clients, which is how do you build a stablecoin strategy? How do you build tokenized deposit? How does that interact with AI? We are very apt at doing this. Would love to help you in that. Even if you don't use us, you need to at least educate your board and the executive team to make a decision around this. That decision probably is not a if, more a when. And when do you start allocating resources towards this and having a game plan? Because this is not something you just turn the switch on. That said, I mentioned already FISERV. Also, I should have mentioned FIS is going to it can enable some stablecoin solutions for their providers. Like there might be some benefits to that. There also might be some very big drawbacks. You might be better off going it alone if you want to get into stablecoins and work with a clearinghouse. It might be cool to have a bunch of credit unions or community banks get together and form their own clearinghouses. I think I see a world where eventually you have a network of networks or a number of clearinghouses kind of that exist today with checks that would facilitate transactions. But I do believe this is here to stay. If for no other reason, it's already facilitating 30-some trillion dollars of payments around the world. Again, most of that's crypto, but $7 to $8 trillion of real money movement is nothing to sneeze at. So with that, I will pause and see if there are any additional questions. I know we're coming up on time. but I appreciate everyone that participated in this today. I know I went through that really fast. This is something I typically do in a board presentation or executive presentation. That's a 2-hour long presentation. We go in a lot more detail, but you guys got a high level feel for what this is like. We would love to work with any of you to give you a deep dive. So I see there are some chats, or hopefully maybe some few questions. Steve, do you want to take some questions from the audience?
I think it was just a thank you for the presentation, Larry, is what we've seen. So
Steve, any last minute questions from you? I hopefully I covered everything that you kind of wanted to know about stable coins and more, but if there's anything I left out or a parting question do you have, let
no,
me.
I think it was a great overview and some things to think through and more to come.
Yep, indeed. Well, with that, really appreciate everyone that's been with us and will continue to be with us in this series. I loved hosting these. I'm not going away. I'm sure I will still host a couple of these, but Steve is going to be the primary contact. If you're interested in being on one of these, reach out to Steve. He is a great resource, has a ton of experience, and I'm really looking forward to working with him and seeing where he takes this and all of our other SRM prospective assets. So with that, thank you very much, and all of you have a wonderful afternoon.